We're back. So we just thought, we're going to jump right into it and kind of do like we do on the pod and, use a couple slides to give you some factual support of the stuff that we want to talk about today. But one of the areas that I think is so pertinent to this crowd, LPs, GPs, founders, which is kind of the state of venture, right? And Bill, you've been at this. I know this is one of the charts that you and I love. Miele gave a speech at Davos last year about the rate at which global GDP doubles. And it just so happens that global GDP actually did not accelerate at all for the better part of 2,000 years. And then with the advent of, free market capitalism, you started to see the rate fall, and GDP is now doubling, every 23 or 25 years. And so you can forecast that ahead, right? And even if you don't assume any acceleration, this is what the curve of global innovation and GDP looks like over the course of the next 100 years. But of course, it's not a straight line. We know that technology is out-earning non-technology, and now we're entering this age of AI, right? And there's a lot of excitement. And so maybe just stop there for a second, Bill, and contextualize a little bit for us what you see happening in the world of venture today, as we enter what may be the biggest super cycle of them all.
Yeah, and I might start with just a quick qualification. So for those of you who don't know, I spent 25 years in venture capital, but I have stepped aside, so I'm not making new investments. Right. Some could argue that means I have less perspective. Some could argue it gives me liberty to say more of what's on my mind without an agenda. And I also have the perspective of time, which I think is what matters most here. I think this is such a unique moment because on one hand, AI is the exact type of event that every founder and every LP and GP dream of. Like disruption is the force that allows these small companies to rise up and be successful against the incumbents. And this type of disruption or dislocation seems so powerful that this is like the perfect moment.
Right.
And there's so many data points to support that. There are a lot of young companies that are growing faster than even the breakout companies that were similar in a previous wave. And so everyone's excited.
Right.
So that's great.
Yes.
The challenge we have, I think, is that over the past 20 years, the way that the venture capital structure and the global framework of venture capital has evolved has created some problems.
Okay, say more.
Well, everyone seems to believe that there are over 1,000 pre-AI unicorns, or pre-LLM unicorns. So they're private. I think they've consumed somewhere between 150 and 200 billion in venture capital dollars.
Right.
But they're kind of stuck.
Right.
And they don't seem to be going anywhere.
Right.
And on top of that, both the IPO market and the M&A market seem to be at kind of lows.
Right. So let's look at, I have some data on this. So this is VC funding through the bubble period of 20 and 21. So this, according to Stepstone, it's basically resetting. Of course, you and I debate all the time. What's the definition of VC these days? Right. That's certainly evolving. This is the number of down rounds in the last 8 quarters. So number of down rounds is clearly accelerating. The number of shutdowns is clearly accelerating. M&A basically screeched to a halt over the course of the last 3 years. This may be changing, but this was one of the places that you and I had a lot of success exiting into over the last few years. This is what you just talked about. We have this massive backlog of companies over $1 billion that don't have an obvious exit today, right? The number of this is, I think, really interesting, and maybe we'll
Well, there's two things. I mean, one thing about the lack of IPOs, prior to this moment in time, we used to talk about the IPO market being open or closed, and it was always correlated with the market.
Exactly.
But last year, the NASDAQ was up what?
Right. 20%.
So why is the window closed?
Right, exactly.
Like that separation.
And you and I have said, this idea that the IPO market is closed is BS. because I also run a big public fund, and I would love to buy reasonably priced private companies that are growing fast coming into the public market, right? The IPO market is wide open. It's just that we have high valuations in the private market, and we have public market investors who are saying, you have to give me a clearing price to make a bid on this asset. And so if you look at this, what's so interesting, if you look at the period 2004, 2005, 2006, and then look at where we are today. So we're 3 years into this recovery. We've got this incredible group of companies that are still private. You know, think of the Stripes and Databricks and SpaceX, et cetera. So we have a group of companies that clearly could be public that are choosing to stay private. And then we've got a backlog of companies that probably would have to take a meaningful down round to get an IPO out the door.
And personally, I think there's two other factors at play, one of which you hinted at. One of them is simply that, and I've talked about this writ large, we don't have to go into it, but the IPO market, the way an IPO is executed is so screwed up that the average company has had to give a 30% discount to go out. And with a liquid private market, you start talking about going public and you can raise money in the private market at a higher price.
Correct.
And they need to fix that, but that's one thing. And then second, the competition in the late stage market has created a world where some of the players, I think, are actively discussing stealing, I'll call it stealing, the growth years of what used to happen in the early years of a public company from the public markets.
Right.
They can get more allocation that way than they would through a standard IPO process. So they're intentionally trying to delay the IPOs.
Right. So,
and I'm not blaming anyone. It's just the dynamic on the field.
And you know, I want to double click on this point to make it very clear. When you and I started our career, let's call it 98 through 2005, the upside of growth companies went to retail investors by way of Fidelity. Because these companies would come public, right? Think
Amazon.
Think of Priceline or Amazon. Priceline I bought in the public markets at $1 billion.
Right. Amazon
I still owned it in the public markets
and Microsoft
at $100 billion.
Yeah.
So I earned 100x return in the public markets, right? By all accounts, venture capitalists would do backflips for that return, but those returns were going to private market participants. It became harder to go public. The cost of being public was higher. Sure. The regulatory burden was higher. But most important, the liquidity, the depth of liquidity in the private markets got a lot deeper and a lot wider. And so take the OpenAI round, the $150 billion round that we participated in, whatever it was, last year. If you looked at that, the cap table for the 10 investors in that round, it would be a dream day one IPO cap table for any company that wanted to enter the public markets. That's why I called it a private IPO at the time.
Yep.
Right? You're raising, you know, in that case, let's call it $10 billion at $150 billion valuation. You know, it's just nomenclature to not call that public. The problem with it is the only people who get access to that are accredited investors, and retail investors are completely cut out.
And I think there's even more than that. But to try and bring it back to things that I think impact the crowd a lot more, the other thing that's going on is I think over the years, so many investors have come to believe in power laws, compounding, network effects.
Yes.
And so if they think something's going to be a winner, not only are they willing to pay more for it,
right,
but they literally come to the table, and if this almost sounds bizarre to say, but I've seen it so many times now. Like, if a company is starting to do well, investors start knocking on the door and say, here, take $100 million. Here, take $300 million.
Right.
Before they're even planning to fundraise.
Right, right.
And that dynamic, I think, has a lot of secondary and tertiary effects.
So let's talk about that, because I think when I talk to founders, particularly during 20 and 21, they would come to me, they would say, you know, I know you're not participating in this round, but I need your advice. Somebody's giving us money at $3 billion. It's unbelievable. I can't believe they're giving us this much money, $300 million at $3 billion. Should I take it, right? And invariably, I would say 99% of the time, 99.5% of the time, founder is going to take the max amount of money at the highest price.
Especially if they're secondary.
Okay. especially if there's secondary, in that round. But Bill, you and I have talked a lot about the adverse consequences to company behavior of taking too much money, that scarcity is a source of innovation. So why is it bad for a company? Talk about the hurdle that gets set up and why it's bad for a company to take too much money at too high a valuation.
Yeah, so I mean, luckily I had a lot of great finance professors and some early mentors that taught me a lot about finance. But one of the phrases everyone uses is valuations represent discounted future expectations.
Right.
And young founders do not think that way. They think that a valuation is a congratulatory trophy for what they've done in the past.
Right.
And they don't realize that
as opposed to a hurdle for the future.
A hurdle for the future, correct. Yeah. There's a great Silicon Valley episode called Raise Less you can find on YouTube that speaks to this issue. But when you don't raise less and you raise more at a higher rate,
yes.
One, your hurdle for what you need to do in the future to succeed again is now really high. And I think that's part of the problem with the zombie unicorns.
Yep.
Two, you're going to take on a burn rate bigger than you would otherwise.
Right.
And I think risk and burn rates are correlated. And there's a ton of people that talk about constraints driving innovation. That was uttered a lot around DeepSeek.
Right.
If you are funding every project now because if you raise $300 million, your burn rate's going to go to what, $100 million a year?
Yes.
I mean, you're funding things now that you wouldn't fund otherwise. You don't have that discussion.
You have 10 priorities instead of 3 priorities.
Correct.
Yeah.
And I think one of the things that happened with the pre-LLM unicorns is the market did reset for a small window before AI took off.
Right.
They all hit the brakes, but they had raised so much money, that when they hit the brakes, they cut out. So let's say there were 10 priorities, they cut out 7 of them.
Right.
And 7 of those were probably driving revenue that's not sustainable.
Right.
And then all their growth rates went down.
Correct.
And so now that's part of why they're stuck.
Right.
And the punchline to all of this is we're doing it all again in AI.
Yeah.
Like we're making all the same mistakes.
Yes.
And I worry about that.
Well, let's talk about that a little bit. So if we think about AI, a couple, we got all these benchmark wars going on, right, in AI. On the left, Bill, I went back. I remember in the late 90s, we're talking about Excite and Lycos and InfoSeek, and we're tracking, how many pages they're indexing. It reminds me a little bit of the benchmark wars today. But when you really ask where value is going to accrue, in the late 90s, every venture capital firm in the country wanted to get one of these logos, right, under their roof. And, there was a $19 billion bidding war between Barry Diller and David Weatherall over Lycos. They had $200 million in revenue. It looked like it would last forever until it came to a screeching halt. And so one of the things I would just posit here as we think about the AI model wars, you hear a lot of people saying today, I would agree with this, that the model itself, just like the search indexes themselves and PageRank, has no intrinsic value. Ultimately, it is an enabler of value to be created by selling a product to a consumer or selling a product to an enterprise. And so what I spend a lot of time thinking about, and I'd love your opinion on this, Bill, is yes, you have to have a good model in order to kind of be in the game with respect to the consumer. But as an example, the reason OpenAI made a lot of sense to us, they just reported last week over 400 million weekly active users, I think over 700 million monthly users, growing fast, et cetera. So the real question over here is, even if on the benchmarks they may be in a similar place, where are they on consumers and where are they on revenue?
Yeah, and so I would disagree with one of the statements you made just because I was around way back then.
Yeah.
The PageRank model was way better. The search was better.
Yeah.
I think it was pretty obvious.
Of Google.
Yeah.
Of Google.
Yeah. I think it was
faster,
demonstrably better.
I would, I mean,
but doesn't matter.
Okay, keep going.
I'll use your, so I do think we can separate the large, this stuff's fun to watch, by the way. So I said recently, it's like large Secession or something, just a lot better.
Yeah.
And you could divide this kind of API world from the consumer world.
Yeah.
And the API world looks highly competitive.
Correct.
And open source plays a huge part.
That's right.
If we're really going to move to 99% inference, other layers matter.
Yes.
Because like someone like a Fireworks can really drive performance. And so all that, that plus a DeepSeek model might be better than one other model on a different platform.
Right.
Just because, and everything gets really optimized for price. And I think that one's most likely to look like Sun and Oracle.
Right.
Like when the internet was born, everyone wanted the best, and all these companies built on Sun and Oracle.
Exactly.
5 years later, it was all Linux and MySQL. And so I think that's more likely to happen on the enterprise side. On the consumer side, I think your point is super interesting.
Yeah.
And OpenAI clearly has escape velocity.
Yeah.
The questions that arise are, is the subscription sustainable? Because your competitive set is different than this competitive set was. Because you've got Elon and X.AI.
Totally. These guys aren't going away. Gemini's not going away.
You got Zuck.
Yes.
You got Google and Gemini.
Correct.
And the more they hear you say OpenAI is breaking away with it, you're probably causing massive problematic meetings inside of the Google complex. And who did I leave out? Like Alexa just relaunched.
Yeah. Well, I mean, speaking of Google, so black line, Google's paid clicks over the last several quarters. So Google knows they have an existential crisis. Organic searches started this year. Lots of companies are now reporting their first quarter. They're saying organic search is down 20 to 40%. Why? Because they're putting AI on top of it. They got to push it down the page. So if you do a query on Google on your phone today, you get an AI embedded answer plus a bunch of paid links. So that's why you're seeing some of this go down. OpenAI, you can see the pacing from the launch of their first consumer product relative to Google and Meta. Sarah just talked on CNBC last week. This year will be over $11 billion. And so you could see that the steepness of that line continues, which, to be fair, also looks like Cursor's path to $100 million, or Sierra, one of Benchmark's investments, which is also going vertical. So clearly, the rate at which these companies are growing revenue is the fastest rate I've seen in my career, faster than internet, faster than mobile, faster than cloud. So this is what we were just talking about, Bill. In the early part of, this is my partner Apoorv, just talking about where value is ultimately going to accrue. And if we look at in the cloud, value really ultimately accrued around applications, right? And a lot of those applications are owned by the cloud providers themselves. But in the early days of AI, of course, NVIDIA is probably the biggest winner.
No doubt.
So infra is winning. But to your point, if infra becomes open because there are a lot of competing inference accelerators and other things that come along, it's likely to bump up to the application layer. You made this point that while consumer may be winner take all, we're probably going to whack it up when it comes to enterprise.
History seems to look that way.
Right. Satya said on the Dwarkish podcast this week, the exact same thing, that enterprise is not winner take all. But I see a lot of companies coming in, starting vertical applications, whether it's in legal or healthcare or whatever. I want your take on...
And they all raised $300 million at $5 billion.
Out of the gates. And that's really what I want to ask you about. In the internet, vertical search worked. There was search for travel and search for healthcare and search for real estate. You and I were in Zillow together.
Yeah.
Go down the line. The question I have about AI is the general intelligence so good that it solves a lot of those vertical problems, right, without needing individual stovepipes, different agents for those things? Any sense on that?
I think I've thought about it a lot. I think there are purchases that are more considered.
Yes.
And in those, I think there's a possibility or that you may favor an AI of that vertical. I'd probably say I believe this about real estate. You're not just saying, hey, ChatGPT, find me a house to buy. There's more involvement than that. And I think the things that are easier to, you could just think, how structurally complex is this? And where is this going to go? The other big question that, and you're back on the consumer side, the other big question on the consumer side is someone that's been an aggregator, take a booking.com, are they going to let themselves get crawled?
Right.
Or not? Or if they don't let themselves get crawled, do you just crawl Expedia and is that good enough?
Right.
Or do companies emerge that are more Stripe-like,
Right.
that are aggregators without an audience,
Right.
who are willing to run, because you got to run at a really thin margin
Right.
to be that kind of aggregator.
Yep.
And maybe we'll see those pop up.
Right.
I don't know. To date, all of the operator type stuff I play with it's still in the like learning phase. It stumbles
Right.
and I think to really rely on something, it's got to have like a 97, 98%
Right.
success rate, and that'll take a while. Like it took a while with self-driving.
Right. Bill and I have a wager on, but to keep myself honest, how long is it going to take before Alexa or ChatGPT can book the Four Seasons in San Francisco for next Tuesday at the lowest price? Right? It's already, obviously, operator and deep research can go out there and act agentically. But in order to do that, you have to have state. You have to know who I am. You have to have my credit card.
We do disagree over the terms a little bit.
Exactly. We both agree we'll get there.
Yes, and I've said you could do a demo 20 years ago of this.
Right.
Because just through scraping. So it's
Right.
like, when is it repeatable and used was the point.
Right, yeah, for sure. One thing I want to shift and talk to, and I'm all over the map here, but bear with us. I want to talk about kind of the state of public markets, in particular with respect to the stuff going on with Doge. I know you and I are both fans of getting rid of regulation, reducing government waste, balancing the budget. But one thing, so this is the market, since the election. Basically, the NASDAQ is up about 4% since the election. But you see some jitteriness in the bond market and in the public markets. If you look at tariffs they're likely to impose, we currently generate about $50 billion in tariff revenue. The president is targeting $500 billion, so a 10x increase in tariff revenue, right? He just announced today, again, China, Canada, Mexico. At the same time, Elon and members of the House and Senate are talking about cutting $1 trillion of government spend. So one way to think about this is $1.5 trillion of government austerity. Now, we all know what happened to the markets, what happened to Bitcoin, what happened to risk assets when the government injected $1.5 trillion of liquidity, right? Markets went vertical. And so I think ironically what people are not yet bracing for is that the success of austerity, the success of balancing the budget, the success of Doge likely means short-term pain for markets. You're withdrawing liquidity from markets, right? GDP is consumer plus investment plus government.
Well, plus there's a large group of VCs that very recently got comfortable with investing in companies that sell to the government.
Right. So, I mean, government spending goes down. There are a lot of folks, who probably get knocked by that. But I would just say if I'm a founder, if I'm a GP, if I'm an LP, the positive impact of this is that the 10-year likely moves lower, right? Because the economy slows a bit, inflation slows a bit, and there's more government discipline around spending. But it also likely means, again, slower economic growth. As an example, I heard a stat the other day that United Airlines ticket sales to the government this year are down 50% year to date, 50. Right? You can imagine most software companies' sales to the government will be down this year. All of that spending cascades into the economy. And so we can debate whether or not that's the right thing to do or the wrong thing to do. But, everybody in this audience has to deal with valuations, right? Where are valuations in the public market? Where are software valuations? You can see in 2021, we were, an order of magnitude above the historical average. Right now we're below the historical average in terms of software multiples. And what I'm arguing to you is that multiples, future discount rate is likely to go up. Why? Because we have more economic uncertainty, we have more political uncertainty, and we have more technology uncertainty. You and I just said technology is moving so fast it's hard to predict. And the inverse of higher discount rates is lower multiples. And lower multiples start in the public markets. That's where most resets occur, and then they cascade into the venture markets. And so as a venture investor, If I'm investing in an early stage company, I may not be thinking as much about this, Bill, but if I'm writing a check into Anduril or SpaceX or a later stage company or Stripe, I'm thinking a lot about this.
Well, and maybe we could close with this. I think one of the challenges of everyone getting so excited and investing in these companies at any price is you look at the public incumbent that you're going after, and at some point,
right,
like it's just too damn close,
right,
like
right.
to where you might end up.
Yeah.
So,
one final thought. You and I have both had really great exits that transformed the lives of founders. At 200 million, at 300 million, at 400 million, at 500 million, that were transformative for the life of founders. My first sale that I did with David Fialco as the co-CEO of a company, we sold for $220 million, and it was game-changing for a 29-year-old Brad Gerstner. And so, again, as you go out to raise that capital, really think long and hard about, is this high valuation and this amount of capital the best thing that I can possibly be doing for this company? I'm setting that future expectation, which means by definition, I'm also cutting off some of the call options along the way. It's something we think a lot about, care a lot about. Appreciate you giving us some time.
Yeah.